Hey everybody, welcome back. Bitcoin is about to hit 62,000 again. And part of the reason why it's going up is because of the macro. You cannot look at crypto without looking at macro. And there's some ugly stuff ahead too, I'm afraid, to share. But it's always important to expect the best but prepare for the worst. So we're going to talk about all the stuff, and a huge thank you to all the people that pepper me every week saying, I want a macro update. So here it is. And this is a bunch of information I've been pulling together for weeks to bring this story to give everybody an idea of exactly what's happening in the world and why, ultimately why we need Bitcoin. So we'll talk about the games that banks play. We'll talk about the labor market, oil, dollar, yen, housing, real estate, junk inflation, why governments love inflation, cracks in the consumer, deficits, military spending, guns and butter, a little bit of history. We'll look at long time frames and short time frames too. So let's jump in, and thank you to the team as well behind me so we can pump out the best content out there every day. The Dumb Founder, that's a cool name. I'm here every day, YouTube and Patreon. Thank you so much. I'm here every day too, so I'll see you there. So, and of course, this is macro, doesn't matter. Let's talk about the big problem. Sometimes a picture says it all. This is the impact of government spending. And by the way, for those of you who are over in Europe and other places, the same is happening in your country. So this is just a microcosm of what's happening around the planet at the same time. So bear that in mind, everybody. All the charts, the most detailed charts I have for US data, but this shows you the linkage between increased government spending and financial market dynamics, and it's critical to understand this. High levels of government expenditure, particularly when financed through increases in debt, flood the market with bonds, reduces their price and increasing yields. Conversely, the finite nature of certain things like the supply of hard assets like Bitcoin will go up. But the key thing to pull out from this is private treasury is expected to increase 2 trillion in 2024. It's actually probably going to be a lot more than that. Now, if you go back to the global financial crisis in 2009, you can see where it was. They printed about 1.3 trillion. We're on target for 2 trillion, 2.5, at least 2.4, I reckon, in 2024. And it's the reasons behind this are so many. But there's a lot happening right now. And again, as I mentioned earlier today, Jerome Powell's body language wasn't confident anymore. He was visibly shaken by the data that he saw. And he probably saw the labor data way before anybody did today. Now, there's other crazy stuff happening, which means I did discuss a few days ago that Janet Yellen, her treasury, was out of money. The kitty's lair. Empty. I get my words confused. The Germans will know what I meant. But JP Morgan Chase, Bank of America, Citigroup have a combined $7.427 trillion worth of off-balance sheet financing. This is the exact scenario that brought about the financial crisis in 2008, 2009. Will history repeat? I don't know. The government is smarter. And there we've seen a lot of action taken very recently as well around things like money supply and everything growing. But again, this is scary. Where do these three banks get $7.2 trillion? Where? There is about $6.2 trillion in money markets. Maybe they just grab that. But the government will have to print. And sadly, job growth stalls hard. Even though these numbers are very fake, they say unemployment rises to 3.9%. 4% is the magic number where Jerome Powell gets spooked. And this chart also shows you how bad the situation is. Traders are pulling forward their Fed rate cut bets based on the soft jobs data that just popped in. That little red column there, April 175,000. Again, 3 months from now, it'll be revised down to about 30 or 40,000. Because the way in which they measure job growth is kind of like the way a caveman used to count rocks in his cave. It's similar. Now, labor market is cooling fast. Another chart to represent that. This shows you the drop in openings in today's JOLTS, and the release is no blip. Private sector sources on job openings such as Indeed and LinkedIn, etc., have been flagging this problem for a while. The labor market is cooling hard and will freeze over by late this year or early 2025. And a recession is coming, unless, of course, the Fed jolts the system. Thank you, Crypto AI. And that wasn't a mistake. Jolt, like electric shock. The government has that power to stimulate the economy. And that's why I do believe money printing will come in hard, especially coming into an election year in November. All this needs to be reversed somehow, and money printing will do that. But there's another problem that's going to make this very ugly in 2025, and that is what I've been talking about for years, since 2022. The AI revolution is helping companies do more with less. It's very simple. And I believe, yes, imagine AI could build 10 million jobs. Yes, it could. But in the process, it'll reduce 40 to 50 million jobs. And that is the scary part. That's the piece that you need to be aware of as you plan your futures out there. Thank you, Meta Girl. Labor demand as well is tanking hard. If you look at the pre-pandemic trend line here, the little dotted line, we have tanked below that. That is not good. Basically, nobody is hiring or drastically reduced rate that they were before. Now, this was an interesting chart too. Shout out to Sanjay for sharing. This Germany is in red, where the famous work ethic seems to have been lost. Germans historically, and I spent a lot of time in Europe, worked more hours than places like Austria, Belgium, Ireland, Italy, Switzerland. And now that table has turned. It's gone down a lot. And the Danish and the Dutch are famous for their work ethic. They work very hard. And I do believe as well, it's very important to work both effectively and efficiently, not waste time. You know, other countries may spend a lot of time at the office talking around the wine cooler or whatever else. The water cooler. It's Friday. I'm looking forward to wine already. But on average here, Germans only work 34 hours a week. That means they work 3 hours less than their OECD average and 4 hours less than the Americans. And if you look at places like Colombia, Turkey, Mexico, Chile, they work a lot more. The question is, how sustainable is this for the future world we are going into? Now, let's switch gears, talk about oil. This is going to be a round the world trip of macro covering all aspects. So buckle in. 90% chance we are in for the high for oil, which kind of is surprising considering OPEC have plans to cut. But this is from Warren Pease, and he believes the top is in. At 90% chance the top is in, I believe, at around $90 a barrel. But that's not good news. What this means is there is a chance of a recession. When there is a recession, there's a drop in demand for oil. It also means high for the yields of 10-year likely as well. So this is also does not paint a good picture. Nothing wrong with good high oil prices because it means the economy is booming. Now, another view of oil topping out. The question is this sluggish oil? And you can see the history of how we went above 125. And by the way, in 2020, during C19, the price of oil went down to almost zero because you couldn't afford to store it. And it's very difficult to store oil. But oil topping out here is a sign that the economy is weak and getting weak, especially if you look at that big dip down from $92 down to $82 in a couple of weeks. Now, there is, again, with ugly gray clouds, sometimes you get a little bit of a silver lining. This is one of them. Between the oil, the economy, the labor data, etc., this tells you that rate cuts are coming. There was a lot of talk over the last month or so when you saw the PCE going up that the Fed was not in control of inflation and they would not be cutting rates in 2024. Well, that's simply not true. So we have three little charts here. One is July. I believe there is more than a 40 to 50% chance of a rate cut in July. According to this chart, there's only a 37.6% chance. But remember, as the bad labor data comes in, that brings these forward to us. Second one is September, 70% chance of Fed rate cuts. Remember as well, the Fed take August off, so there is no meeting in August, so we jump from July to September. So they can't typically, the way it works, if I was leaving the office for a month, I wouldn't leave the office for a day, by the way. But if I was to leave for a month, I'd want to make sure I'd have all my affairs arranged. And they can't just disappear for the summer holidays and expect everything to be fine. So that's where I do believe July we could have a cut. But either way, 70% chance of rate cuts in September, an 80% chance of rate cuts in November. And November is, of course, when the elections are happening. So I think you can take it as a certainty we're going to get rate cuts this year. Now, the US dollar is also in a little bit of a problem. This is the dollar shrinking share per the IMF of global reserves. We know because of BRICS and other things, FX allocations as a percentage of total allocated to the fall has fallen from 75% approximately to 57% right now. And that is the lowest level since 1995. And it turns out overregulating and weaponizing the dollar wasn't a good idea. If only somebody warned about that. And now there's the backlash where people do not want to hold dollars. Again, enter Bitcoin. There'll be more people holding that because they know what's happening and they know how much fiat is being printed, not just for the dollar, but for other fiats all over the world. Now, there is a piece of good news too related to that, and that is the future projections for Treasury bonds, the TLT, from the Game of Trades. Looking ahead, we can anticipate a rebound in Treasury bond prices in the short term. The TLT is nearing a local bottom. You can see the two little bottoms there, October 2023 and April 2024. And we're getting ready for a profitable bounce. So those that got into the TLT too early, it was a costly trade. But now there's a chance to get a good 20 to 30% positive gain as well as we go forward. Hey, Joseph, good to see you up late as usual. Now, another view of this. So just, we have the situation right now with gold relative performance compared to the TLT that we just covered and government spending. Notice the correlation, okay? Now, the other angle of this, I'd love to take this chart and divide it by M2 to see exactly what the actual performance is. Either way, it doesn't matter. The reason we are here is because if you can imagine, government spending is going to increase. Therefore, the gold TLT ratio will increase too. We know the TLT is going up, so will gold. So my question is, imagine what Bitcoin's going to do, because we know it far outperforms gold. So another reason to hold Bitcoin. Now, I did cover this morning. For the first time in 65 years, we saw a buy signal. Because of the first time in 65 years, we saw the M2 money supply go down. Now it's going up, and it's going to go up fast. And that too will also pump the price of Bitcoin, because M2 is going to fly. It simply has to. Everything is about to break. Now, another good news too, I did say it would be a mixed signals. Crypto funding is back up to $2.5 billion. And that is good quarterly investment for Q1 2024. Nothing like the Q1 2022 amount of about $12 billion, but still creeping back. It's nice to see the trend reverse. And real estate, for the realtors and real estate professionals out there in the audience, I see some of you. In nominal terms, the Case-Shiller index and the Case-Shiller Composite 20 index, that is the red versus the blue, which is the Case-Shiller for the national home price in the US, are both at all-time highs. Both indexes increased in February. And this is kind of strange, but one of the reasons for this is there was in last year, 2023, there wasn't a lot of supply on the market. But there was still some demand, and that meant prices went higher. This year, there is more supply on the market, but nothing is selling really that I see. I see a lot of for sale stuff. Not a lot of stuff is closing, but at the same time, rates are very, very high. And I don't quite understand why Case-Shiller is saying we're at all-time highs, because that's not some of the data I see. And like many other things out there in the world, your dollar or your fiat currency does not go as far. The cost to buy a house in America in 2024 now costs over $2,750 a month. In 2020, it was $1,400. So the cost has doubled in 4 years. In 2006, we had towards the end of the real estate bubble, towards the global financial crisis, the cost was $1,500. .com bubble, $1,600. And in 1981, it was $900 a month at 18% mortgage rates. Crazy, crazy history here. And this cost, by the way, is inclusive of mortgage, taxes, insurance, and assumes a 13% down payment, not a 20% or a 10%, exactly 13%. But I thought that was very interesting. But basically, renters are more popular now than home buyers because nobody can afford a 7.2% 30-year fixed mortgage rate. Now, another view of this too, remember this also is where we are. During the late 70s, mortgage rates went to 18%. That's what you see in that spike there. But if you ignore that history in the late 70s, and that was only a temporary spike with it, that was not long-lived, home buyers now can expect to spend 41% of their gross income on mortgage costs. This is the highest rate of mortgage burden since the late 70s, again when they were 18%. So there is no historical precedent for this lack of affordability lasting. Something has to give. Either real estate prices will crash or rates have to come down. That's it. That's either or a combination of both is going to happen. Now, there's other scary, scary stuff that, I hope Jerome Powell sees this data. If I see it, he's got to be able to see it. RIP housing, construction job openings implode, falling from 456,000 jobs to 274,000. That is the biggest monthly drop on record. And they've been measuring this for decades. We have never seen literally an industry grind to a halt. That is the construction industry. The reason there's no building is because there's no selling. And it takes time to build a house. Therefore, they need to be able to sell what they have before they build new ones. That's the problem right here. Now, why I believe the Case-Shiller is dead. If you check this, you see the Case-Shiller index up, blue. You go to the median sales price of houses sold in the US and in the Netherlands and in Germany. Big bubble actually in Amsterdam right now on real estate. I forgot to include that chart. I shared it, I think, a week or two ago, or on Patreon. But here you can see the median sales price of houses sold has tanked also, the most ever, at least in my lifetime, which is stunning. So what the heck is up with the Case-Shiller? I don't know. Bizarre. A lot of government data is also very bizarre. And the dollar-yen is in the tank. The yen just hit a more than 30-year low against the dollar, which despite, nobody wants to hold dollars and FX right now, it still is doing a hell of a lot better than the yen, which is causing a lot of problems there. Now let's talk about inflation, which is all tied to fiat. This is junk food inflation, and the Happy Meal is now gone. You can see the menu price inflation at every fast food chain in America has outpaced CPI inflation in the country since 2014, often by 100% or more, like McDonald's. I heard somebody went into a McDonald's once, and this is from Charlie Bolillo, but it was something like they bought a Big Mac meal and they hadn't been there in decades, and it used to be $2.99 for a Big Mac meal, and now it was $12 or $13. So anyway, don't eat that garbage anyway. It'll shorten your life. Okay. Another sign as well that the consumer is cracking. McDonald's, speaking of junk food, and other big brands warn that low-income consumers are starting to crack because not only has the price gone up, but they have less disposable income. And we saw the same thing happen as well with Starbucks. Now, flipping over to the UK consumer has spent a lot more and got a lot less. The UK households, so if you look at the pink line, that's the actual dollar spend, and the blue is how much they're getting from the Financial Times. And they have reduced purchases of beer by 15%, confectionery 10%, meat 7%, bread and fruit by 9%, over the last 2 years. However, they still spent a hell of a lot more than they did before, and levels 2 years and more before. And that is a huge problem. And that will also be a problem for the Prime Minister Rishi Sunak, who faces big challenges in the upcoming election because the feel-good factor is not there. People realize when they get 15% less beer and they're spending a lot more money, it's a problem, especially on a Friday night. Anyway, and why? This is a beautiful chart too. Why do governments love stealthy inflation? They'll pretend it's 2% or 3%. Well, really, we know it's not. I just showed you McDonald's prices going up 100% in a couple of years. It's nuts. But this is why the governments love stealthy inflation. This graph shows an inverse relationship between inflation, the CPI, and the public debt to GDP ratio. When inflation is high, the debt to GDP ratio increases, and as the real value of debt is reduced. Okay, so even though, let me get the lines here, CPI is in gold, green is in the debt. As you can see, the spike in CPI actually helped reduce the debt to GDP ratio. If that didn't exist, you could expect the green line to be a lot more than 135%. But it's going to get back there again. But this is why governments love inflation. And this is why they pretend to get to this magical uniform 2% inflation per year, which is basically stealing 2% out of your back pocket every year, when in reality, it's more like the McDonald's chart here of 100%. So crazy times. But this helps the government make their data and statistics look better than they actually are. Now, another piece from the Financial Times. This is how military spending around the world has grown up almost 7% last year. You can see even America's quite a big step. Asia, Oceania, a big step. Middle East, a big step too. Africa is pretty stable. And Europe, big step as well, I guess, for Europe too. But what's really interesting is how this is all in perspective to other forms of spending. We are seeing massive increases in social spending, also military spending. But if you take military expenditures as a percentage of the total budget and you look at social expenditures, it's going through the roof. Okay, and if you look at the history of actual spend in the G7 countries between 1870 and 2022, you can see we are now spending less on defense than we did under the Weimar Republic after the Treaty of Versailles. Okay, and then we also know there are certain players in the world that are not doing this, they're doing the opposite. But the other big thing is social expenditures are rising like crazy, and they're going to get a lot worse over time, especially with aging populations, AI, and everything else. And this is causing this problem, deficits. This is old data, by the way, from October 2023, the last time I have the official US deficit comparison to revenue. So spending is the green stuff, 6.13 trillion. That's going up and to the moon. Revenue, 4.44 trillion, is going down. And deficit is going to explode. That's why I do believe there will be an additional $2.4 trillion in borrowing in the US this year. And you can take this, and basically every government in the world will look pretty much similar as well. And there's a lot of unhappiness out there too. This is a picture of the back of a board from a farmer's truck in, I think, the Netherlands. But farming is the art of losing money while working 400 hours a month to feed people who think you are trying to kill them. And the rules and regulations across Europe are really making these normally very, very quiet people speak up and protest and drop poop on government buildings and such. So respect your farmers. You need them more than they need you. And final chart of the day, ladies and gentlemen, and this one is a shocker. And again, I don't know what the deal is in other parts of the world, but this is from Rutger Bregman. It's a stunning graph that shows you the plummeting tax rates of the richest Americans. And for the first time in history, billionaires have a lower effective tax rate than working class Americans. running in around 22%, 23%. That is not right. And that's because of the tax loopholes. If you don't abuse the tax loopholes, you will be paying more taxes. But that's one of the things that are out there. You need a very good team of accountants and lawyers and obfuscation to hide all that money. So with that, everybody, hope you like your monthly macro roundup. Sorry for the grief tidings, but prepare. And Bitcoin will, if you take 10 of these slides, it all translates into things like Bitcoin going up because fiat is going down. And things are going to get worse before they're going to get better. Thank you all for coming. Happy Friday. See you all tomorrow. Bitcoin Daily in the morning and then the weekly recap in the afternoon. Have a good night, everybody. Bye-bye.